When it comes to investing, one of the most important concepts to understand is a balanced portfolio. As an investor, you're often told that having a well-balanced portfolio can help you manage risk while aiming for steady returns over time. But what exactly does this mean, and how can you create one? Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that will be discussed is intended for information and educational purposes only. It should not be considered investment advice or investment recommendations. Whenever you invest, your capital is at risk. What is a balanced portfolio? A balanced portfolio is an investment strategy that spreads money across different types of assets to reduce risk. The general idea is to combine investments that perform differently under various market conditions. This way, when one part of your portfolio isn't doing well, another part might be performing better, helping to keep your overall investment more stable or balanced. But what makes a portfolio balanced? A portfolio is considered balanced when it includes a mix of different asset classes that work together to reduce risk and provide steady returns. The balance comes from diversification, meaning that the investments do not all react the same way to market changes. And here's what makes a portfolio balanced. A mix of asset classes, a combination of stocks, which offer growth but can be volatile, bonds, which provide stability and income, and sometimes other investments like real estate or commodities. This ensures that the different assets perform well at different times. We'll go into more detail on these later on. Risk management. Some investments, like stocks, are higher risk but offer higher potential returns, while others, like bonds, are lower risk but offer steadier income. A balanced portfolio includes both, so the investor isn't relying too much on any single type of asset, i.e. it's not super risky or too cautious. Adaptability to market conditions. When stock prices drop, bonds or other assets may hold their value or even increase, reducing overall losses. This counterbalance helps keep the portfolio from experiencing extreme ups and downs. Proportional allocation. The typical balanced portfolio often follows a 60-40 rule, 60% stocks, 40% bonds, because it aims to strike a balance between growth and stability. Stocks provide the opportunity for capital appreciation, helping investors grow their wealth over time, while bonds act as more of a stabilizer, reducing overall volatility and providing steady income. This allocation has been traditionally used because historical data suggests that it offers a good mix of risk and return. Stocks tend to perform well over the long run, but they can be volatile in the short term. Bonds, on the other hand, are less risky and can cushion losses when stock markets decline. This combination makes the 60-40 portfolio a popular choice for investors who want moderate risk and consistent returns. However, I should say that this ratio is not fixed. It can vary depending on an investor's risk tolerance and time horizon. Regular rebalancing. Over time, some investments may grow faster than others, throwing off the balance. For example, if stocks grow significantly, they might make up 70% of the portfolio instead of the intended 60%. Rebalancing just means adjusting the portfolio by selling some assets and then buying others to maintain the target allocation. This process ensures that the investor remains aligned with their risk tolerance and financial goals. I've done more of an explanation on rebalancing in this video. Failing to rebalance can expose investors to unintended risk. For instance, if the stock grows too much in a bull market, the portfolio may become riskier than intended, leading to significant losses in a downturn. On the other hand, frequent rebalancing may incur transaction fees, the attrition of buying and selling regularly, and taxes. So investors must strike a balance between maintaining allocation and minimizing costs. The key components of a balanced portfolio. A typical balanced portfolio includes a mix of these types of assets. Stocks. Investing in shares of companies can provide long-term growth. However, they can be volatile, meaning their value can rise and fall sharply. Bonds. Government and corporate bonds provide a more stable and predictable income. UK government bonds, gilts, are considered low-risk investments. Cash and cash equivalents. Savings accounts, money market funds, and premium bonds provide liquidity and safety, though they generally offer lower returns. Property and real estate investments. Investing in property either directly by buying real estate or indirectly through real estate investment trusts or REITs can provide a stable income through rent and potential appreciation. Commodities and alternative investments. This includes gold, oil, or even cryptocurrency. These can act as a hedge against inflation, but may be more speculative. Do you need all of that? No, you don't need all these asset types to have a balanced portfolio. The key is diversification, but that doesn't mean adding everything available. A balanced portfolio simply means having a solid mix of assets that spread risk effectively. For example, a traditional balanced portfolio might only include stocks and bonds, e.g. 60% stocks, 40% bonds. Some investors may add real estate or commodities to provide extra diversification, and then others might keep it simpler, sticking with stocks and cash for liquidity. The problem with adding too many assets. While diversification is important for managing risk and improving long-term financial stability, there is a point where adding too many different assets to a portfolio can actually become counterproductive. One major drawback is overcomplication. If you hold too many different investments across various asset classes, tracking their individual performances and making informed decisions about rebalancing becomes increasingly difficult. Instead of streamlining portfolio management, excessive diversification can lead to a scattered and inefficient investment approach, making it harder to respond to market changes in a timely manner. Another concern is the potential for higher costs. Certain investments, such as real estate funds, hedge funds, or alternative assets, often come with higher fees and transaction costs. If an investor spreads their capital too thinly across numerous holdings, these fees can accumulate quickly, ultimately reducing net returns. Additionally, actively managing a large and complex portfolio may require more frequent trades, further increasing transaction costs and tax liabilities. Excessive diversification can also dilute potential gains. When a portfolio is spread across too many asset types, even if some investments perform exceptionally well, their impact on overall returns may be minimal. In a highly diversified portfolio, the strong performance of a few outstanding assets might be offset by the weaker performance of others, leading to mediocre overall returns rather than allowing the best investments to drive meaningful growth. Furthermore, too much diversification can lead to redundant investments. Some assets may respond similarly to market conditions, meaning they don't provide as much additional diversification as you might think. For example, if an investor already owns a broad selection of UK stocks, adding another UK-based equity fund might not be significantly reducing risk or enhancing returns. Instead, it may just increase the complexity of owning and managing without offering substantial benefits. Ultimately, while diversification remains a fundamental principle of sound investing, it's important to strike a balance. Rather than indiscriminately adding more assets to a portfolio, investors should focus on selecting high-quality investments that complement one another and align with their financial goals. And by the way, if you're looking for somewhere to buy a range of assets like I'm talking about in this video, then this is also where the sponsor of today's video comes in, XTB. With XTB's investment app, you gain access to over 3,600 stocks and ETFs across 14 global markets, including both the FTSE 100 and S&P 500. XTB's recent ISA promotion is definitely an eye-catcher. Where most brokers are offering a decreased rate, XTB is offering a boosted 6.5% interest rate on uninvested funds for 90 days, a 2% increase from their standard variable AER of 4.5%. And this applies to both new and existing customers, with the promotional period running from March the 1st to April 30th, 2025. The platform offers advanced tools such as detailed stock analysis, live market updates, and educational resources tailored to investors of all levels. Its user-friendly interface simplifies portfolio management, allowing you to reinvest dividends and monitor your financial goals effectively. Additionally, XTB's low transaction fees and commission-free trading on certain accounts makes it an attractive choice for cost-conscious investors during uncertain times. If you want to try out XTB for yourself, then there's a link to sign up in the description and pinned comment of this video. Capital at risk. Why bother to balance your portfolio? Balancing your portfolio helps reduce risk. Imagine putting all your money into one type of investment like stocks. If the stock market crashes, you could lose a significant portion of your money. But if you spread your investment across different stocks, bonds, and other assets, a decline in one area might be offset by gains in another. This means you hopefully don't get annihilated if the stock market crashes. How to build a balanced portfolio. Assess your risk tolerance. Are you comfortable taking risks, or do you prefer more stable investments? Diversify across asset classes. Don't put all your money in one place. A mix of assets ensures better protection, so in terms of stocks, consider sector and geographic diversification too. Consider your investment horizon. If you're investing for retirement 30 years from now, you can take more risks. If you need the money in 5 years, you might opt for safer options. Regularly rebalance your portfolio. Over time, some investments might grow more than others, changing your balance. Reviewing and adjusting your portfolio annually helps maintain your desired risk level. Here's an example of a balanced portfolio for a UK investor. A common way to structure a balanced portfolio is the 60-40 strategy mentioned earlier. So 60% in stocks, diversified UK and global equities, including FTSE 100 and S&P 500 companies, and then 40% in bonds, a mix of UK gilts and corporate bonds. Alternatively, a more conservative investor might go for something like 40% stocks, 40% bonds, and 20% in real estate or commodities even. The problem is that there isn't some strict guideline on what you should do. It depends on a range of factors like what you hope to get out of your investments, as well as your risk tolerance. Final thoughts. A balanced portfolio is key to managing investment risks while aiming for steady returns. However, balance doesn't mean adding as many investments as possible. It's about finding the right mix of assets to spread risk effectively. By diversifying across different asset types without overcomplicating your investments, UK investors can build a portfolio suited to their financial goals, risk tolerance, and time horizon. Whether you're a beginner or an experienced investor, maintaining a balanced approach can help you navigate market ups and downs with confidence. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!